Alright guys, Tiger Quantis here. We're kicking off a series of educational videos focused on Momentum X approach, methodology, indicators, and what's not. A full spectrum of elements and components and tools that we can actually use in the market to be successful. Today, we're kicking off with one of the first videos, and we're going to start with a topic that is very, very critical to understand. So we're going to focus on understanding how we construct our portfolio and very much the math and the psychology behind the 60 to 100% annual returns. Ideally, more math, less emotions, and then the right type of psychology that gets you to the right results. Now, let's kick it off. Let's talk about what we're going to cover today. Let's then jump into each one of the four pillars that drive that type of performance. We're going to cover portfolio structure, optimal concentration and the number of positions, the scaling process and the process for sizing and letting the winners run and then cutting the losers early. And we're also going to unearth and uncover and explain the whole math behind 60 to 100% in annual returns, proving and showing the edge. Again, if you cannot show the edge, you probably not going to be able to achieve it. And lastly, we're going to wrap up with a summary and some of the next steps, include this mirror board for you to be able to browse and look at it, as well as some of the additional videos. Those are going to be included in the description of this video. Okay, well, let's move on to the four pillars. The way we look at it is as follows. We look at the structure and how the portfolio is constructed. We look at concentration and focus. Again, we actually believe that concentrated positions give better returns, and the sweet spot that we found is 6 to 10 positions. We're going to explain it in more detail in a bit. We're also going to talk about the process of scaling into the positions, the sizing, and the way of controlling the risk, minimizing the losers, and then obviously letting the winners run. And lastly, we're going to explain the expected value math behind those numbers, the statistical edge, and how the risk is managed. Let's keep moving. So the first pillar and the three tiers of the portfolio architecture. Over the many years, we came to a clear understanding where and how to create an edge by constructing the right type of portfolio. We look at it as follows. We have the concept of core positions that represent about 50 to 60%, and we're going to explain those in more detail. You're going to see us using words like base plus catalyst. This is actually quite core to our do-base algorithm. And the idea is very much focused on basically winning with outsized asymmetric returns for the upside and then minimizing the risk to the downside. We'll explain it in a bit more detail shortly. Tactical trades that are very much momentum and trend-based trades. A lot of those in 2025 were AI momentum trades for us and for many others. And so we're going to explain how we look at those and how we execute on those. And then moonshots. Over the years, we clearly identified the right size for the moonshots, knowing that many of the moonshots may fail. But if we allocate 10 to 15% with a potential return of 3x up to 10x, they actually have a very, very strong and positive impact on our portfolio. Okay, with that, well, let's jump in and talk about the concept of core positions as a foundation. So when we reflect on it, and the way we got to it is essentially the concept of base plus catalyst. So what does it mean? One of the pioneers, I would say, in many ways of the concept was Ted Warren, one of our most favorite investors. In 1966, he wrote a book called How to Make Stock Market Make Money for You. And the book was all about the whole approach for investing and the way he approached it. What was interesting about Ted Warren is he was able to generate quite significant returns, varying between 80% to 140%. Back then, Ted had no quantitative tools. He was using a specific approach, calculating everything on the notepad and notebook and getting to some of the interesting results. But the point was this. What he came to realize is that the best play, especially for retail investors, is essentially a play where you can pick up the stocks that are in a basing pattern. It's typically a stock that has been in a drawdown or or in a specific markdown process for months or years, a longer base period that followed, that essentially established the base and the foundation. And essentially, it's a coiling spring that is ready to run. For us, it's an interesting evolution. We took a lot of the ideas from TED, developed and codified a system that allows to scan the market, screen for the stocks, identify the best possible plays, and then help us to understand if institutions are actually accumulating those positions and if insiders are trading them as well, and then give us a very clear signal from a volume accumulation and a momentum perspective to enter in time. The idea here is not just to pick up good companies, it's to pick up positions with asymmetric returns and rewards for the upside, and then a catalyst event that we want to be able to catch and minimize any type of risk. We typically expect 70 to 80% win rate in those positions. We would hold them 2 months to 2 years. Sometimes we would go in and out periodically, knowing that it's going to continue to go up for the next couple of years. That's very much a foundation and a base for our portfolio. Next, we're going to talk about tactical positions and the moonshots. Tactical positions, in our case, are pretty straightforward. We use the indicators from the momentum perspective to identify breakouts and identify a move that is very much driven by a rotation of the money from one sector to the next. And we want to be able to benefit from that move on a basis of a couple of weeks to a couple of months. Typically, we see 65% win rate in those type of positions for us. In aggregate, with core positions of 70 to 80% win rate and tactical positions of 65, we could average close to 75, sometimes 76% win rate in general. And then lastly, moonshot. So we talked about it briefly just a few seconds ago. The idea is pretty straightforward. Over the years, we learned that including moonshots had extremely positive acceleration impact on our portfolio. Taking some of those asymmetric bets in biopharma, mining, some of the crypto stocks gave us a very interesting impact. You could pick something that could give you 5x, 10x type of return, even if you lose 55, and in our case, we're actually edging quite close to 60%. You generate a very, very nice impact on your portfolio. We don't keep more than 10 to 15% in those positions, but they do create an additional push and additional edge for our portfolio. Okay, moving along, let's talk about the focus and the concentration. We talked about the optimal number of positions. How do we know that? Well, over the many years, we run the analysis, we run back testing, we run forward testing, we analyzed investing in small caps, mid caps, large caps, a mixed portfolio. What was interesting, it was quite consistent that the sweet spot is between 6 to 10 positions. Above 10, we diluted our returns. Below 6, we increased volatility and drawdowns in a portfolio. And so number 8 was smack in the middle. And so it was very evident that we wanted to stay within that range. When I talk about positions, I don't necessarily mean one specific stock or asset, like copper is a position, buying a mining company is a position, buying one of the large players like NVIDIA is a position. Now, we look at it as not only as a stock, but also as a theme of investment. So for example, this season, we ended up investing in lithium, and instead of buying one single stock like ALB, we bought ALB and SQM, and we also doubled in LAC. So the point is that we mixed it up in such a way that we could focus on a specific investment theme with a momentum in the market, but we mixed it up in such a way that we could pick a number of those because we did not know which one would actually go up higher and faster. We wanted to diversify, and we counted it as one position. So again, a position is not always a specific one asset or stock. It could be a number of plays that are concentrated around a specific investment theme. Okay, with that level of understanding, let's move on. Let's talk about the scaling in process and the mechanics of the entry. It's absolutely critical, and critical for many reasons. At the foundational level, the goal of the scaling process is to increase the average size of a winner type of position and decrease the size of the losing position. Over the years, we came to the stats that on average our winning position is about 6.5% and our losing position is around 4.5%. We never go in full size in. That's a very much more of a mature retail type of experience where people go in and buy 10, 15, 20% in a given position. That's a big no-no, and it's a no-no for many reasons. Number one, stock market is a probability-based play, and essentially you need to assume that even if a probability is small, it still could lead to a loss. So for us, the idea is simple. We go in with initial 5%, we add additional 3% when we have a confirmation, and in some cases, primarily in the core type of positions, we scale all the way to 10%. Now, the whole mechanism of scaling in has a number of advantages. A, it minimizes the losses, but it also helps us to avoid fake outs. That's actually a good example of a loss because we have a quite sophisticated system that gives us a chance of generating 70+% win rate. And so it doesn't happen often, but we also learned that not everything in our control. So for example, in 2025, the interesting example was the tariffs. We identified copper as one of the high potential plays. We picked up a few mining companies. One of them was a Canadian mining, copper mining company. And as we were buying it, and as we started to realize a very nice return, Trump actually announced tariffs on Canada. And so essentially within weeks, the price fell, and it fell by 20+%. And so that was a good example of a fake out. Could we have predicted it? No. Is position sizing helped us, and scaling in at 5% helped? Absolutely. So instead of losing 2% on that position by throwing in all 10%, we lost less than 1%. We went in with 4.5% or close to 5. We stopped at around 20%, which was actually less than 1% from overall portfolio. Again, a good example of how protecting yourself and minimizing the size of the losers and also avoiding fake outs is essentially the logic behind the scaling in process and the sizing of the position. Okay, let's go to the math behind all of that. Let's bring it all together and then explain how the math works. So there is an expected value equation in front of you right now. It has a few key concepts. It has a probability of success, capital allocation, and then magnitude of a move. We talked about the capital allocation. We just talked about the fact that we're looking to get to about 6.5% return on the winning trades. We're looking to size down and control the size of the losing trades to about 4.5%. So that's the size. Our stats basically show that our win rate is around 73 to 75%. We're estimating it approximately right now at 73.5. We estimate our losing percent of trades at 26.5, basically a mirror image of the flip side of the winning. And then from a loss perspective, on the win side, we estimate around 35% on average per winning trade, and then around 20%, between 15 to 20% from a losing perspective. And that's primarily because we also put stop losses close to 20%. So with that, if you sum it all up, you get the following equation. You get the calculation on a winner's side at around 1.67%. And then on the loser's side, it equates to about minus 0.24. Bringing those two together, combining them, we get a net expected value of about 1.43%. So what does it actually mean? What do we do with that number? Well, let's translate it into returns. So if we understand the concept of 1.43% per trade, we can then project basically what it could look like. At 20 trades a year, it would equate with compounding to about 33% return. At 30 trades per year with compounding, it would equate to about 53% per year. And then if we raise that number close to 40 plus, close to 50, it's actually 104% a year. Now, notice we actually not including in those calculations and in our math the moonshots. They always bring a nice positive upshot in our portfolio. But generally speaking, if you do the math, 30 to 50 trades per year works out to only a couple of trades per month, maybe maximum 4 or 5 trades per month. That's really sort of how the equation works out, and it's quite logical. We do combine some of the core positions with tactical positions, and that's where we get to those numbers. Okay, few important things. You can actually go to our website, look at our performance dashboard. It will give you the information. The link to the performance dashboard is in the description of this video. You're also going to be able to get a full list of trades. Why am I showing that to you? Well, because you can actually look at our past trades and see the win rate, and see also an average return per winning trade. So that's going to give you a bit of a sense. In your case, when you're constructing your own portfolio, you need to track your trades and figure out what's your winning rate and what's your average return per trade. And that's going to help you with the math and with optimizing your execution. Lastly, some of the elements that absolutely need to be considered when you're thinking through your portfolio and the math behind it, you need to think about the worst case scenario. So based on those percentages, the worst case scenario for us would be 5 to 6 consecutive losses. The interesting part is that the probability of that is only 0.14%. And then what's also interesting, that even if they happen, that would not affect us significantly because we're minimizing the losses. So most of the time we would be at 5% per position, and we would be minimizing the loss to about 20 to 25% maximum. And so that equates to about maybe a percent per trade, maybe a percent, 1.25% loss per trade. All in total, that would not be a significant impact on our portfolio. We would survive it absolutely fine, and we'd do absolutely fine in the market. But again, we're sharing that concept so you can actually consider it in your own calculations. All right, well, that brings us to the flight deck. All that logic, all those concepts, all those ideas essentially were implemented on our flight deck on our site. The idea is to allow us to organize the core positions, tactical positions, and moonshot positions. We want to be able to track our scaling in process. We want to be able to track our exit targets and risk and returns, or risk and rewards per position. The idea is to be able to get a full picture of what's happening and how well we're positioned. And all of that is essentially used on our side and also by our users. It's a great tool. We developed it over the years. We keep fine-tuning it, including the right type of signals. And we also have a full video just dedicated to a flight deck. That's more of a kind of how-to and execution video that is going to be shared in the description on this video as well as on our website. And that brings us to a wrap-up. So the goal for the first video was to tell you about our approach and the system for constructing a portfolio for asymmetric returns. The key concepts that you should take away is the concept of the core positions that are very much core and foundational with high probabilities, the tactical, momentum, and trend type of positions that allow us to capture the moves in the market as the capital rotates from one sector to the next, and then obviously moonshots that could add a very nice upshot to our portfolio. At the core of that thinking is the concept of minimizing risk or reducing risk. In our case, we want to be able to manage risk by reducing losing positions to about 4.5% and increasing winning positions to 6.5%, and obviously also including a return per trade. The concept of scaling is absolutely critical, and now you also have the math to calculate what does it mean per trade and what the compounding could look like. With that, play a more intelligent game, and thank you for your time.